Now I think we've just started the next bull market, the next leg up, which I think will be at least proportionate to the first leg, which was, the 250 to 1900. But that's a huge increase in the price of gold. You're talking about 6, 7 times increase from here. And, we're 2,600 or from 2000, let's say. So a six-fold increase from 2000 is 12,000. 7 is 14,000. So kind of at a minimum, we're going up there. But I think the potential is much higher because we're just going to print so much money. We're going to have so much inflation that the dollar is going to lose so much value that you're really going to need a lot of dollars to buy gold.
The gold market has been signaling crucial insights about the global economy, particularly concerning interest rates and inflation. Despite what may appear to be historically high interest rates, the rising price of gold suggests that these rates are still insufficient to curb inflationary pressures. Traditionally, investors turn to gold when they lose confidence in fiat currencies or when inflation expectations increase. The consistent upward trend in gold prices reflects skepticism toward the Federal Reserve's ability to contain inflation effectively, suggesting that interest rates should be raised further. Recently, the Federal Reserve reduced its benchmark interest rate by 0.5 percentage point, following more than 2 years of elevated rates that had helped moderate inflation but made borrowing more burdensome for American consumers. According to the Associated Press, this marks the Fed's first rate cut over 4 years, bringing the federal borrowing rate down from 4.75% to 5%. Peter Schiff points out that inflation never fully returned to the Federal Reserve's target of 2%. While official reports may estimate inflation at around 3%, real-world inflation, experienced by consumers in everyday purchases, is likely closer to 6%. This gap arises from how inflation is calculated, which often understates the true increase in the cost of living. Following the Federal Reserve's recent rate cut, gold prices initially spiked to $2,600 per ounce before settling at $2,553, finding key support around the $2,532 level. While there may be some further pullback in the short term, the larger macroeconomic context suggests a strong upward trajectory for gold in the longer term. The current environment, defined by ongoing monetary expansion, escalating national debt, and persistent inflationary pressures, provides a solid foundation for a continued rise in gold's value. Historically, gold has responded to such conditions by appreciating significantly, and this time may be no different. Peter Schiff notes that based on historical precedents, the price of gold could increase 6 to 7 times its current levels, potentially reaching as high as $12,000 or more per ounce. Now, let's watch the clips from the interview. Before we proceed, please take a moment to like this video, subscribe to the channel, and hit the notification bell so you don't miss any future updates.
Gold is telling you that interest rates are too low. They should be higher. The Fed should be hiking, not cutting.
Right.
That's why gold is making a new record high every week. And it's going a lot higher as the Fed continues down the wrong path. And they're talking about that inflation is gone. It's not gone at all. It's going to reemerge stronger than ever. Not that it ever disappeared. Inflation never got back down to the Fed's so-called 2% target. We're about 3% the way the government measures it, which means we're like 6% the way consumers pay it, because the real prices probably rise twice as fast as what the government will admit in the CPI. But that said, the CPI is finished going down, and now it's headed back up. We got up to 9% was the high year over year, and we've been banging around 3% for the last year or so. That's kind of like the bottom. And I think we're trending back up, and by 2025, we can easily be back up at 9% again, year over year, maybe higher.
I want to go to that point you made about everybody's funding our deficits on the international side. What changes that? Because the reality is so much of that is just because of the industrial military complex, bases everywhere. When you have guns and you've got the military stationed in countries like Germany, it seems that it's hard to really back away from funding the U.S. government when they're your defense.
I mean, that's true. I mean, we're all over the world. We've got our troops all over the world, but we can't afford to deploy them. We can't afford to provision them without borrowing money. That is not sustainable. It's going to crumble. And I don't think the world is going to pay an ever increasing tribute to the United States to maintain this situation. I think it's going to come to an end. Yes, it's gone on for a long time. Our military has been part of what's probably enabled it. But then again, we still have to pay for a lot of that military, and it's very expensive. We're broke, so, we can't really afford it. Gold was in a bear market from 1980-81 until 2001. So it had a 20-year bear market where it went from 850 down to 250 approximately. Then it had another bull market where it went from 250 up to 1900. And that bull market peaked in 2011, and it really lasted just 10 years. So that was the initial breakout from the bear market. Then we pulled back and we had a consolidation where we went from 1900 down to about 1,000 in 2015, then back up to 2,000 in 2020. But we pretty much stayed between 1,700 and 1,900 for a few years. We didn't really break considerably above 2,000, get to 2,100 until this year. And so now I think we've just started the next bull market, the next leg up, which I think will be at least proportionate to the first leg, which was, the 250 to 1900. But that's a huge increase in the price of gold. You're talking about 6-7 times increase from here. And, we're at 2,600 or from 2,000, let's say. So a six-fold increase from 2,000 is 12,000. 7 is 14,000. So kind of at a minimum, we're going up there. But I think the potential is much higher because we're just going to print so much money. We're going to have so much inflation that the dollar is going to lose so much value that you're really going to need a lot of dollars to buy gold. And, if gold can go from $20 an ounce to $2,600 an ounce, it can go from 2,600 to 26,000 or to 100,000, right? I mean, there's no limit because, again, gold's not changing. All we're doing is decreasing the value of the dollar. And they could print them, they could drop trillions of dollars out of helicopters, right? What stops them? Right? So, I mean, how much is the price of gold in Zimbabwe? Anybody know? How many trillions of Zimbabwe dollars do you need to buy an ounce of gold? But, at one point, the Zimbabwe dollar and the US dollar were 1-to-1. I forget when, but I think that was the case for a while.
The current gold bull market is experiencing an intriguing twist as gold mining stocks struggle to match the pace of the metal itself. Traditionally, these stocks serve as leading indicators, incorporating anticipated price increases into their valuations. However, they have lagged this time, only catching up when gold reaches new highs and suffering disproportionately during minor corrections. For example, when gold prices dip by $50 to $100, gold stocks often experience 10% to 20% declines. This unusual trend can be attributed to a persistent skepticism surrounding the bull market's strength. Despite gold's steady rise amid economic turbulence, many analysts have maintained a cautious outlook, downplaying the metal's long-term potential due to inflation and broader macroeconomic risks. However, recent market developments suggest that a turnaround may be on the horizon for gold mining stocks. As inflationary pressures continue to mount, analysts predict that earnings from gold mining companies could exceed expectations in the latter half of the year. This could lead to increased dividends, share buybacks, and a wave of mergers and acquisitions within the sector, rekindling investor interest.
It's just that normally, in a bull market, you would expect the gold stocks to lead the metal, that they would anticipate higher gold prices, and so they would incorporate that into the price, into the PE multiples. But what's been interesting or unique about this bull market is that the gold mining stocks have lagged, and they constantly have to catch up. Gold will go up and make a new high, and the gold stocks will eventually go up. Gold will have a small correction. Maybe gold drops 50, 100 bucks. Gold stocks will get killed by 10%, maybe 20%. Then gold will make a new high, and gold stocks will start to come back up, and then it keeps making new high, new high, new high, and then eventually the gold stocks make a new high, and then gold has a correction, and the gold stocks get killed again. And so they're really having a hard time outperforming gold like you would expect them to do. And I think that's because nobody believes this bull market. They've been bearish the whole way. It's been climbing the mother of all walls of worry. I think that is going to change. I mean, you look at the big gold stocks like the Barrick and the Newmonts, they're trading at discounts, sharp discounts to the S&P 500. They historically traded premiums. And so they're cheap. The gold companies are priced to book. They're historically low. So there's a lot of bargain here. And I think that we're going to start to see the gold stocks coming in with some big earnings beats. Third quarter, I think this quarter, and especially Q4, which we'll get those numbers in next year. But I think we're going to see big beats. These major companies are going to be announcing increases in dividends. They're going to increase share buybacks. Then you're going to start to see some consolidation, more acquisitions. The market is eventually going to really go up. And, one of the problems that the gold stocks have had is that they've been an ironic victim of inflation. And it's ironic because you would think that they would benefit from inflation. But inflation drove up the cost of mining. But the price of gold didn't go up commensurate with that. Even though it's gone up a lot, mining costs have gone up even more. And I think that that's changing. I think you're going to see gold going up a lot more than the cost of mining it. In fact, if you look at oil today, oil's at an all-time record low priced in gold. You can get almost 40 barrels of oil for an ounce of gold. That's great for gold mining companies. And the wages now are not, running because they're not, the US dollar has not been that weak. Normally you have a weak dollar relative to other currencies in a gold bull market, but we've had gold moving up with the dollar, stable to firmer. Although it's been weakening recently, it hasn't really gotten killed. The DXY is still above 100. And so you wouldn't have thought that we'd have $2,600 gold with a dollar index still above 100, but we do. But that's great for the gold mining companies because their wages are not in dollars. And so, I think they're going to really start to make up for, the lost ground. And Wall Street is completely off guard. Nobody really is following this sector. In fact, earlier this year, back in February, March, several of the brokerage firms downgraded Newmont, downgraded Barrick to basically sells when gold was just about 2,000. And those stocks hit multi-year lows. Earlier this year, you had multi-year lows in the largest gold mining companies. I mean, I took advantage of that. I was buying more myself, even though I already owned a lot. I couldn't, help it. I had to buy more because I wasn't going to, let that gift, just go away. And I was pounding the table on my podcast back then, telling people you got to buy these stocks when Wall Street is giving them away because they're basically capitulating. And I remember when they downgraded, was it Barrick? The analyst said, "I'm downgrading it because I don't see any upside potential in gold. Gold's at 2,000. It's fully priced. It's not going to go up. So why buy a gold stock when gold can't go up?" And of course, then gold had its best year probably since that guy's been alive.
If the Federal Reserve further cuts interest rates, Peter Schiff cautions that inflation may spiral out of control, damaging the Fed's credibility and resulting in the collapse of the US dollar. He believes the dollar's days as the world's reserve currency are numbered, with de-dollarization already happening and set to accelerate. This shift could trigger major financial disruptions in the US economy. Schiff predicts that gold will become the ultimate safe haven during this turmoil, potentially reaching prices of $10,000 an ounce, as central banks pivot away from the dollar and gold reestablishes itself as the primary global reserve asset. Share your thoughts on Peter's analysis in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.